Afternoon, everybody. Thanks for joining this Facebook live, or if you're watching on the catch up. So, my name is Tony Pound. I'm an independent financial advisor, a money and health coach. And in this video, what I want to try and talk you through is the 3 accounts that I believe you need to be able to build your wealth. If you've not met me before, then as I say, I help the running community become physically and financially resilient. So what I'm looking to do is just try and pass on a little bit of information that I use with my financial planning clients, just to run through the types of accounts that I would be looking to help them with or expect them to have. So I'm very visual, so I've had to draw this down as I usually do with my clients. So we'll start with the first account. So the first account that I would expect people to have is some sort of savings account. And this should be instant access, so it should be easily available to you. And this is where I would expect people to hold funds that they know they're going to need in the next couple of weeks or months. So typically, I would expect people to hold that sort of thing in just a savings account. So things for emergencies, for example, or holidays, those sort of things. And the analogy that I use the analogy of a kitchen, and I've heard it called the 3 buckets. But essentially, that early or emergency money should be held in something like, the analogy being your cupboard. So in your kitchen, your cupboard is where you would store things that you know you're going to need in the coming weeks. Depending what items it is, breads and things like that, then you know you're going to be looking at using those in the short term. So in this case, that's going to be your savings accounts. As we know, savings accounts, the interest rates on them at the moment are really, really low. But this isn't about getting a good return for your money. This is just about being able to access the money in the event of the emergency, or as and when you need to. So if it is for things like holidays coming up, you save for car insurances, all of those sort of things. That's just being able to get access to it as in when you need it, as well as then plan for the things that are coming up in the month. So things like emergency monies, you'd look to hold really between 3 to 6 months of essential outgoings in there. And then on top of that, you would maybe look to hold the other savings, or then ideally you could siphon those off into a different savings account for things that you know are going to come up in the year. So that's your first account. So that's just a savings account. And I say, don't get overly worried about what the interest rate is on those. That essentially is just for money that you're going to access. So it's not about the returns. The next account that I would expect somebody to look to have is an ISA, is a stocks and shares ISA. So this is where you would look to hold money for that longer term. So this is more the medium term. So these are more like 5 years and over. So the analogy for the kitchen is it comes back to the fridge. So again, it's things you're looking to put away for the longer term. And with the stocks and shares ISA, you're allowed to put away up to £20,000 each tax year. So if you're married, then you both get that allowance. So there's £40,000 a year that you could put away into a tax efficient environment. Now, in terms of how you invest within that stocks and shares ISA, that will depend on what your attitude to risk is, how long you're looking to invest for, what your capacity for losses. So do you have other savings and emergency funds that you can access should you need access to money in the medium or the short term? And then you just look to invest it within some sort of portfolio or multi-asset fund to get you the best return. There are things like cash ISAs. Now, cash ISAs aren't as great as they used to be, just because the nature of the interest rate is pretty low. We all get our own savings allowance now, so in terms of the interest that's added to you in savings accounts, that's all paid gross, and depending on what your tax situation is whether actually you need to pay any additional tax on there at all. So cash ISAs aren't as great as they used to be, but with stocks and shares ISAs, that allows you to put money away, build the growth on there, and then there's no capital gains tax to pay on it when you do cash it in. So this could be things for like children's university costs. It could be things where you're saving for a big birthday, and it's like over 5 years away, then this could be an area that you could look at. So that's just a stocks and shares ISA. And then in terms of the freezer element of that kitchen analogy, what you're looking at then is the long-term savings. So that's going to be your pension plan. So with a pension, you're looking to save for when you want to reduce your hours and not work as hard. So typically that's anywhere from, if you're fortunate, 55 and over. Most people have a traditional retirement age of 65, but essentially it's just about replacing the lost income if you were to sort of like start to reduce your hours or give up work totally and do something else. So with the pension, it's very tax efficient. There's some great incentives to be paying into them. So if you're employed, then your company will have a pension for you, which they will contribute on your behalf. You can also then contribute into it as well, and often your employer will match up to a certain limit. So you want to make sure you're paying up to get that full match. Essentially it's free money, or you can look at it another way, it's a pay rise. So you want to make sure that you'll maximum out those things in your company pension. If you have the ability to save additional funds, then you can either add it into the existing pension or you can look to set your own private pension. If you're self-employed, then nobody's going to do it for you. You're going to need to do that yourself, and you'll need to set up your own personal pension and again make the payments in there from your self-employed income, and that has huge tax benefits as well when you do your self-assessment. If you're a one-man band and you run your own limited company, again there's tax advantages to making those payments through your limited company that I'm sure if you speak to your accountant they can talk you through. So those are really the three accounts that I would expect somebody to have to be able to build wealth. So let's just recap. So what we're looking at is some sort of cash savings where you can just put money away for the emergencies, for the short-term spend, like car insurances, your short-term holidays that are coming up, those sort of things. Stocks and shares ISA, so that's going to be where you put money away that you're going to need in the medium to long term, and so I commonly believe that to be 5 years and over. The good thing about investing money is, yes, it will go up and go down. The longer you leave it in, the better, but it's got a better chance of beating inflation and getting you a real return on your money. And then for the longer term is your retirement plan. It's starting to save as early as you can do for when you get older and you want to reduce your hours, walk away from the job you're doing, change jobs, change careers, all sorts of things. But that pot is then saving into a pension, whether that's through your employer or whether that's through your own personal pension. So hopefully that's been helpful. I plan to do these Facebook Lives every Friday at 12 o'clock. Just give you some additional tips. So if there's anything you'd like to cover, then just let me know and maybe that'll be my next video. So look forward to seeing you soon. Take care.